A passive investor is a set it and forget it system. This is something now where you can invest in something like ETFs, index funds, mutual funds, real estate crowdfunded deals, where you're going to invest in something else and you set it and forget it. You're not managing the investment yourself. You're not actually running the investment yourself. You're just going to fund it and let it be managed by something else. That's passive investing. The nice thing about this is less work, less risk, but also a little bit less upside. Active investing is now you're going to actually be the one that is managing the deal. This might be investing in individual stocks. This might be going on and investing in multifamily real estate or single family real estate, where you're going to put the deal together, you're going to manage the deal. It's more work, more risk, but also more potential upside. And you got to decide what's right for you. You don't have to pick one or the other, and neither one of these is better than the other, but you got to know what's better for you. Because for the average person, if you don't want to sit there and read financial statements, if you don't want to sit there and have to look at properties, if you don't have to sit there and call property management companies, deal with contractors, deal with the city, then being a passive investor is better. But if you say, well, Jaspreet, I like reading financial statements. I like reading income statements, balance sheets. I like listening to earnings calls. I want to keep up with companies. I want to study these things. And if I want to invest in real estate, well, I don't mind that work of having to find a property and dealing with realtors and dealing with accountants, dealing with attorneys, dealing with property managers, dealing with the insurance companies. I don't mind doing that. I would enjoy that because that's something that I want to do. Well, then you can look more into being an active investor. Me, I don't recommend what I do to anybody else. I am an active investor. I'm also a passive investor. I passively invest my money into stocks. I passively invest my money into some real estate deals. I also actively invest my money into individual companies. I also actively invest my money into real estate. I've also actively invested my money into other investments as well, but that's more on the growth side, so I'm not going to ignore that right now. But the bulk of my investments here are for cash flow, and then I have some for active and some for passive. But let's dig a little bit deeper. But I do want to remind you that for those of you that like this sort of stuff and you want to stay up to date on the financial markets, that way you know what's happening, when it's happening, I've created a free resource for you. It's called Market Briefs, where every day my team is working to break down what's happening in things like the economy, the stock market, the crypto market, the global economy, and our own economy into a fun, reading, easy to read newsletter. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below, where you can go to briefs.co/market. As an example of how this would look in action, again, I'm not telling you what to invest in, just an example. If you went out and you invested in the Verizon company, VZ, this would be a form of active investing because you're investing in the individual company. And at the time I'm recording this video, Verizon's paying right around a 6.5% dividend, a 6.5% yield. That means if you invested $100 into Verizon today, you'd make $6.50 about in dividends. This money you would get deposited into your bank account for doing nothing except owning the stock. Sounds pretty good. On the flip side, on the passive investment side, I gave an example of an ETF called NOBL. Noble is an ETF that gives you exposure to dividend-paying companies in the S&P 500 that are part of the Dividend Aristocrat Club. So what does that mean? They're in the S&P 500. They're a part of the 500 largest companies in the stock market, but they're only the dividend-paying companies in the S&P 500 because not every company in the S&P 500 pays a dividend. So you take a look at the 500 largest companies in the stock market, you pick out the ones that pick dividends. This is investing in those, but it gets a little bit more specific because it's only investing in the dividend aristocrats. A dividend aristocrat is a company that has paid out and increased its dividend every year for the last 25 years. So this is investing in companies in the S&P 500 that pay a dividend and have increased their dividend every year for at least the last 25 years. This is a fund, this is an individual company. And at the time of me recording this video, NOBL is paying a dividend of around 2% a year. Now you might look at this and say, well, Jaspreet, this is paying 6.5%, this is paying 2%. It seems like a no-brainer. This seems like a better investment. But what you got to remember now, especially as a cash flow investor, is that you're not just investing for the cash flow, you're investing in the underlying asset. And when you're investing in one company, you take on all the risk. If Verizon dominates and they take over the world, well, now your investment goes up and your cash flow goes up. If Verizon goes bankrupt, well, now not only do you lose your cash flow, you also lose the money that you invested. Here you're protected because you're investing in a broader portfolio of companies. And let's just take a look at how Verizon and Noble have done over the last 5 years. Over the last 5 years, Verizon has fallen by around 25%, even though they're paying out that 6% some dividend. And on the other hand, NOBL has grown by around 50% over the last 5 years, even though they're paying out a smaller dividend. This is where I need you to understand when you are investing, what you want to be investing in, whether it's for cash flow or something else, is you are investing in the underlying asset. That is what is important. Don't get attracted to just this number here by itself. That number is something you want to look at, but make sure you're analyzing the underlying investment, because the last thing you want is to get attracted to a good yield, but then find out you're investing in a crappy asset, because now your money goes down and then eventually the yield will go away as well. So when you're investing your money, especially for cash flow, make sure you're doing your due diligence. Make sure you're doing your research and investing in something that you believe in. And this is where you want to start to learn. How do you read an income statement? How do you read a balance sheet? How do you read a cash flow statement? And how do you start to study the underlying company? This is what you want to spend your financial education studying, is starting to understand what it is that you're investing in. And now we're going to go a little bit deeper. Let's assume that you want to be, whether it's an active investor or a passive investor, it does not matter. The next thing I want you to think about now is, what asset do you want to be investing in? Do you want to invest in stocks? Do you want to invest in real estate? These are the two asset classes that have built more passive wealth than anything else in the last century. And the reason why I say passive wealth is because the three asset classes that have built more wealth than anything else over the last century in the United States are starting a business, real estate, and stocks. Starting a business is great, but that takes the most work and the most risk. And that's a topic that's a little bit of a deviation away from what we're talking about here. But stocks and real estate are two asset classes that you can do kind of passively, that can build wealth and that have been proven to build more wealth than anything else over the last century. So now that you understand, if you want to invest for cash flow or growth, you can ask, do you want to be an active or passive investor? Then the next question is, you want to invest in stocks or real estate? The nice thing about investing in stocks is you can manage it off your phone. You can start investing, I mean, in a matter of minutes. You just open up a brokerage account and you can start investing with as little as $100, $10, even $1 nowadays with a lot of the new brokerage tools out there. So you don't need a lot of money to start. You can start investing pretty much right now. And you can get exposure to the broader economy, which is the nice part about the stock market. The con with the stock market is it can be very emotional, because when you start investing, especially if you don't have the psychology, you start monitoring the stock market day to day. You buy a stock, you buy a fund, and now you start taking a look at it every day. But if you bought a home tomorrow, you're not going to look at Zillow in the afternoon and say, did my home price rise or fall? It doesn't make any sense. You would know that that's silly. But people do that with the stock market all the time. And so if you're going to be investing in stocks, you really have to be a master of emotions. With real estate, you own a hard asset. It's something that you can see, feel, and touch. You can generate cash flow. When you invest in real estate, you're primarily investing for cash flow, because you're going to buy a property and rent it out to somebody living there, rent it out to a business using it, rent it out to somebody using your property. And then you're going to get the cash flow, which should, if you do it correctly, cover all your property expenses. That's your property taxes, your insurance, your maintenance, your management fees, and your vacancy costs, and put some money in your pocket every single month. That's the right way to do real estate. You own a hard asset, you get cash flow, and has some of the biggest and best tax breaks that our tax code has to offer. Although I am a licensed attorney, I'm not your attorney. What you got to understand is that real estate investors love real estate partially because of those tax breaks. The downfall with real estate is it takes more work. You're going to deal with property managers. You're going to be dealing with contractors. You're going to be dealing with city halls. You're going to be dealing with more people. It takes more work to get started. It takes more time to get started, and it takes more money to get started. There are people that will tell you that you can do the zero money down real estate game, and I will tell you from experience that I made a lot of money with zero money down real estate, not because I bought the deals with zero money down, but because people will buy deals with zero money down, get foreclosed on by multiple banks, and then the banks will sell the property to somebody like me. So be very cautious. Understand that the more debt that you take on, the more risk that you take on. A lot of people love selling you this idea that you can just buy real estate even if you don't have the means, don't have the skills, don't have anything. Well, if it was so easy, everybody would be doing it, and you don't want to be the person that loses his shirt because he didn't know what you were doing and he just jumped in because some random guru on the internet told you to do so. Have money to invest first. You got to start with the money first, and then invest money. And just always remember, the more debt you take on, the more risk you take on. And if you start a business with debt, well, you're starting with somebody else's money in a very risky game. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.